Hi everyone, it's Chris Snow with C21 Coastal, and thank you again for joining us on our video blog. Today's topic is a topic we chose from our email out requesting topics, and the winner of our contest was Mike Reiner. And Mike had given us a topic today of how to avoid PMI. Really, what is it and how to avoid it? So thanks again, Mike, for sending in the suggestion, and thank you to everyone who participated. Just a quick reminder that we have a couple of resources on the video blog. If you're looking at purchasing a home, please click here. If you're looking at selling a home, please click here. And now back to our topic. What is PMI and how to avoid it? I thought the best thing for us to do is to bring in a lender to explain that. Patrick Park is here with me. He is with Home Harbor Financial. And Pat has been a great resource for me and my team over the last 5 years. He does a lot of lending for us. And I figured he was the best person to tackle this topic. So Pat, thanks again for joining us.
Thank you, Hap.
And if we can jump right into the topic, what is private mortgage insurance, and is there any benefit to having private mortgage insurance?
Private mortgage insurance is a policy taken out by the lender, paid by the borrower, that protects them in case the mortgage ever goes into default.
Okay. And what loans would have to have mortgage insurance?
FHA, VA, USDA, and conforming loans, your Fannies and Freddie Mac.
Okay. Is there any benefit really to having mortgage insurance? Does it benefit the buyer or borrower any way, shape, or form to have mortgage insurance?
The benefit is mostly just for the lender.
Okay. All right. And so with that being said, if it's only a benefit to the lender, how can our folks that are listening out there, how can they avoid how can they avoid private mortgage insurance?
If you put down 20% on your purchase, or if you do a combination first and second mortgage, you can get rid of the private mortgage insurance, or you can also look towards the lender paid mortgage insurance, which comes with a slightly higher rate, but it allows you not to have that monthly mortgage insurance premium. Those second loans could be either a home equity line or a fixed rate second.
Okay, all right, so there's some flexibility on that. Probably a little bit more in closing costs because you have two loans there.
That's correct.
Okay, all right. And then the last option you said was the lender paid mortgage insurance. I hear the term LPMI a lot. So let's say conforming rate right now is 3.5%. What would be if someone was getting lender paid mortgage insurance? What's the difference in rate look like?
If you have a credit score over 760, you may see an eighth adjustment in your rate. So it would be like 3.625.
Okay, so very minimal. Let's say they don't have stellar credit. What would be a worst case scenario and still be able to have that lender paid mortgage insurance?
The lowest you can go down to, I believe, is a 660 credit score. And lender paid mortgage insurance is probably not something you'd want to look at because it's very expensive at that.
Okay. So maybe going back the route of an 80%, 10%, something like that.
Or just do borrower paid MI.
Okay. If you are, if you end up having to get borrower paid mortgage insurance, is it stuck with the loan for the life of the loan, or can it get removed? What are your options there?
A lot of them are different. When you look at conforming, typically will fall off at 78 to 80% loan to value.
So they have to get an appraisal done, or?
Yes, an appraisal will be done, or the lender can do it through their automated system.
Okay, all right. So if the borrower doesn't do anything and they just keep making their mortgage payments every year, at some point when they get to 80% loan to value off the original loan, it should fall off. If it doesn't, they can request it. How soon can they request it? Let's say they bought the house, 6 months ago, and all of a sudden they've got a lot more equity in the property. Can they request it off then, or do they have to wait in a certain period of time?
I always tell my clients after 2 years, look towards what the value is of your property and see if you can get it removed at that point. Because obviously if you have a 30-year fixed mortgage, you're paying down less principal than a 15-year. So if you've got a 15-year mortgage, you would be paying down the principal faster, and you'd reach that 78 to 80% loan to value.
A lot faster. Okay. Well, I think that covers this as far as the topic. Is there anything else that you can think of that people would need to know as far as private mortgage insurance?
I think that's pretty good.
Okay. All right. Well, thanks again for joining us today. And if you have any questions or want further clarification on lender-paid mortgage insurance, you can reply back to this video email, and we will get you in contact with the right person to answer those questions.